Most investors believe diversification makes them safer. But Warren Buffett says it may actually be a sign you don't know what you're redoing. Welcome to Money Mastery Insights, where we break down timeless money lessons in a simple, practical, and easy-to-understand way. One of the most common pieces of investing advice sounds like this: diversify your portfolio to reduce risk. You'll hear it from financial advisors, books, podcasts, and almost everywhere else. So when Warren Buffett says, diversification is protection against ignorance, it naturally raises eyebrows. Is Buffett saying diversification is bad? Not exactly. What he's really talking about is the difference between investing with understanding and investing with uncertainty. Buffett believes that risk doesn't come from owning fewer investments. It comes from owning investments you don't understand. Let's break this down in simple terms. Imagine you own a business. You know how it makes money. You understand its customers, its competitors, and why it continues to succeed year after year. Now imagine someone tells you to sell most of it and instead buy tiny pieces of 50 random businesses you know nothing about, just to be safe. That wouldn't feel safer. It would feel more uncertain. This is the core of Buffett's philosophy. When investors don't understand what they own, they spread their money across many different assets to reduce the damage of being wrong. In that case, diversification becomes a defensive strategy. But when an investor truly understands a business, its economics, its long-term value, and its competitive strength, spreading money too thin can actually dilute returns. That's why Buffett has often concentrated his investments in a few high-quality companies he deeply believes in, such as Coca-Cola and Apple. He didn't buy them because they were trendy. He bought them because he understood them. Now, this doesn't mean Buffett ignores risk. It means he manages risk differently. Instead of relying on diversification to protect him, he relies on knowledge, patience, and discipline. For most investors, the real danger isn't owning too few stocks. It's buying things they don't understand, chasing headlines, or reacting emotionally to market noise. Buffett's quote isn't a rule, it's a warning. A warning that diversification should never replace thinking. Diversification protects investors who lack deep understanding. True risk comes from not knowing what you own. Knowledge and conviction reduce risk more than spreading money blindly. Long-term investing rewards patience, focus, and clarity practical application. So how can an everyday investor apply this wisdom responsibly? First, stay within your circle of competence. Only invest in businesses or funds you can explain in plain language. Second, prioritize quality over quantity. You don't need dozens of investments to succeed. You need a few solid ones you trust. Third, keep learning before expanding. As your understanding grows, your ability to invest confidently improves. And finally, think long-term. Buffett's greatest advantage wasn't intelligence. It was patience. You don't need to invest like Warren Buffett, but thinking like him can dramatically improve your results. Warren Buffett reminds us that safety doesn't come from owning more. It comes from understanding better. When you know what you own and why you own it, investing becomes calmer, clearer, and far more effective. If you value thoughtful, long-term investing insights like this, make sure to subscribe to Money Mastery Insights for more timeless lessons that help you build wealth with confidence and clarity.